In a world of high-frequency trading, AI algorithms, and 24-hour crypto markets, the richest investor in history sits in a quiet office in Omaha, drinking cherry Coke and reading newspapers. He doesn't have a wall of monitors. He doesn't panic when the market crashes. He doesn't chase the latest hype. Yet, he has crushed the market for over 50 years. How? Because while everyone else is playing the stock market game, Warren Buffett is playing the business accumulation game. Welcome back to You Inc. Today we are going to download the operating system of the greatest capitalist of our time. We are going to learn how to think like Buffett and invest like a businessman. This is not about copying his portfolio, it is about copying his psychology. The first shift in your CEO mindset is this: a stock is not a ticker symbol. It is not a wiggling line on a chart. A stock is a legal claim on a real business. It represents factories, inventory, patents, and people working 9 to 5. When Buffett buys a share of Apple, he doesn't think, "I hope this piece of paper goes up next week." He thinks, "I now own a portion of the iPhone ecosystem." As the CEO of You Inc., ask yourself before every trade, if the stock market closed down for 5 years tomorrow, would I be happy owning this business? If the answer is no, you are speculating, not investing. A business owner looks at the cash flow the company generates, not the price someone else is willing to pay for it. But how do we deal with the daily price fluctuations? Buffett gave us the greatest mental tool ever invented, Mr. Market. Imagine you are partners in a private business with a manic depressive man named Mr. Market. Every day, he comes to your office. Some days, he is euphoric and offers to buy your share for a ridiculously high price. Other days, he is depressed and offers to sell you his share for a ridiculously low price. Here is the key. Mr. Market is there to serve you, not to guide you. Most investors let Mr. Market tell them what to do. When he yells, crashes, they get scared. When he cheers, bubbles, they get greedy. A business owner ignores Mr. Market's emotions and looks at his wallet. If he offers a bargain, you buy. If he offers a fortune, you sell. Otherwise, you go back to work. A great CEO knows what they don't know. This is called the circle of competence. Buffett missed the dot-com boom. People called him a dinosaur. He didn't care. He said, "I don't understand tech companies, so I won't buy them." Then the bubble burst, and the dinosaur was the only one left standing. You Inc. must define its territory. Are you an expert in semiconductors? Are you an expert in consumer brands? There is no penalty in the stock market for saying, "I don't know." You don't have to swing at every pitch. You can stand at the plate with the bat on your shoulder for years, waiting for the perfect pitch in your sweet spot. Staying inside your circle is not weakness, it is discipline. Now, let's talk about the deal. Buffett's mentor Ben Graham taught him, price is what you pay, value is what you get. A businessman never pays full retail price. He wants a discount. If a business is worth $100 million, Buffett wants to buy it for $70 million. That $30 million gap is called the margin of safety. Why do you need this margin? Because you might be wrong, because the economy might crash, because the CEO might make a mistake. The margin of safety protects You Inc. from bad luck. If you buy a dollar for 50 cents, you don't need to be a genius to make money. You just need to wait. Finally, let's talk about activity. Modern culture tells us, don't just sit there, do something. Buffett says, don't do something, just sit there. He suggests that you should operate as if you have a punch card with only 20 slots for your entire lifetime. Every time you buy a stock, you punch a hole. When the card is full, you can never buy again. If you only had 20 investments in your life, would you waste one on a risky penny stock? Would you buy something because a YouTuber mentioned it? No. You would research deeply. You would be patient. You would bet big only when the odds are overwhelmingly in your favor. Activity is the enemy of returns. Lethargy, bordering on sloth, is the style of the successful business owner. Today, we learned the Buffett way. Own the business, ignore the noise, stay in your circle, buy at a discount, do nothing for a long time. This is a proven path to immense wealth. But is it the only path? Buffett is a long-term investor. But there are others who run you Inkins as short-term traders. They don't care about the business. They care about the price action. They don't hold for years. They hold for days. Is that wrong? Not necessarily. It is just a different business model. In our next episode, we will stand at a crossroads. We will compare the short-term trader versus the long-term investor. We will help you decide which business model fits your personality, your capital, and your lifestyle. Until then, sit on your hands and think like a capitalist. See you in the next video.